Let's take a look at how the short vanilla put option strategy works for when you're selling put options. This is for when you have a bullish to neutral view on the market, or you expect volatility to decrease. In a short vanilla put option strategy, you want the price of the option to fall. This will occur if the underlying asset rises or stagnates, or if volatility decreases. Your maximum loss is unlimited, albeit capped if the underlying goes to zero, and your maximum gain is limited to the premium. Remember our definition of a put: the right but not the obligation to sell a set quantity of a security at a predetermined price within a set time frame. By shorting a vanilla put option, you're selling this right to the buyer. Let's take the example of a December DAX 11,000 put option with a bid-ask spread of 95 to 100. Imagine you sell two put options at 95, receiving 2 times 1 times 95, which is €190 with a contract size of €1. While a purchaser of a put option pays a premium for the right, as a seller you receive this premium. Say the German 30 is trading at 12,000, but rallies to 12,200 and the price of your put option falls from 95 to 75. You could close your position and make a profit of 20 points per contract, or €40. If at expiry the German 30 has stayed above the strike of 11,000, then the option expires out of the money. Therefore, you would keep the premium and make a profit of €190, which you received at the start. That's your maximum profit. However, if the market starts to fall below the strike, the option is then in the money. This will begin to eat away at your premium. When you sell a put, your break-even is equal to the strike minus the option price. That's the same whether you're buying or selling. In this case, it's 11,000 minus 95, or 10,905. Let's say the market falls below the strike to say 10,850 at expiry. The put will close at a price of 150. You initially sold the put at 95 and bought it back at 150, leaving you with a loss of 55 points or €110 in total. The lower the DAX price when your short option expires, the bigger your loss. For this reason, in terms of risk, buying and selling options are very different. While buying options has unlimited upside, selling options has unlimited downside, so just beware that selling options carries considerably more risk. So how is selling options reflected in your IG account? In this example, when you sell a put option, you receive the premium of €190. There's a small commission of 10 cents per contract, but that's excluded here for simplicity. Your cash balance goes up by the amount of the premium that you receive. You're then short an asset, the value of which is reflected in the sold option value column, as shown at the top of your account. This is the live marked-to-market value of your option. It's equal to what you would pay if you chose to buy your option back, and is calculated by the buy price multiplied by your position size. Your P&L is equal to the difference between the price you sold the option at and the current buy price of the option multiplied by your position size. When selling options, a margin is always incurred of 2% on the underlying. Your account value equals cash plus your sold option value. When you close your option, the sold option value, P&L and margin all go back to zero. If the option expires out of the money, you'll keep the premium and your cash balance won't change. Please note, if the position moves against you, you may need to meet a margin call or risk having your position closed out if you don't have the funds required on your account. Also note, if you leave an option to expiry, you won't get charged the commission. All IG options are cash settled. Please see the settlement rules in the platform for more information. You can trade vanilla options on a range of markets with IG. If you want to see more videos like this, let us know in the comments below, and don't forget to subscribe to IG.